The last week in crypto has been quite a whirlwind. A lot has happened, so let's start the market update, where I'll discuss what the most important events have been and what significant events are expected to happen in the coming days and weeks. The truth is, we've dropped to quite a drastic level, $74,500, which means we had about a 32.5% correction on Bitcoin from the very peak, as you can see now on the screen. So, the fact of what happened is not encouraging, but there is probably a good chance that the worst is behind us. And indeed, in a moment like this, the strongest will survive, those who simply wait patiently. But besides waiting for better times, it's worth knowing when they will come and what might potentially trigger them. That's why I'm creating this video today. From that moment, precisely, from $74,500, Bitcoin has already increased in value by over 15% to this day. So let's say that since those declines, things have only gotten better. We're climbing slowly, very slowly, but still climbing that ladder with an average increase of over $1,000 per day, which indeed gradually brings back optimism to those who truly invest in and consider crypto. The fact that this bull market might not be over because Bitcoin hasn't continued to fall. At least for now, it doesn't want to. Alright, so the truth is, moving forward, for which stocks and cryptocurrencies have been exposed to strong fluctuations due to, well, unstable, right? There's this decision by the US President, Trump, which was about tariffs, right? And here, chaos, he sowed a lot of discord. Someone even wrote to me in a comment recently, saying, "Hey, Merrick, you must be in love with Trump because you keep talking about him." No, it's not that I'm in love, it's just that the impact of his decisions and generally the whole USA, currently on the cryptocurrency market and related economic topics is huge, so it's impossible not to talk about it, right? I believe it's one of the priority things that you need to stay updated on. So investors are wondering here, right? How his broad actions might affect the slowdown of economic growth and strengthen inflation. So there was a lot of uncertainty in the market, a lot of volatility, and the indices took very large drops, even in single sessions, not seen in years. However, moving forward, let's see how recent news might actually cause the markets to finally, after such a trading quarter, because the truth is, it's already been 10, 11, 12 weeks. We are continuously falling with some slight consolidation, how the coming months might cause the market to finally return to a growth mode, because last week we had quite a plot twist regarding the trade war. For now, the president announced a 90-day pause in the U.S. trade war with the entire world. He also said that over 180 countries will receive temporary relief, but goods from China will still be subject to strict tariffs, raising the total rate on that country to 125%. And the market's reaction has been very positive since then. And for now, the stock market is simply rising. Maybe not dramatically strong, but it is rising. And the question that can be asked is the bottom behind us? Let's check it out. Personally and subjectively, based on various analyses and thoughts I've had in recent days and weeks, I believe that the bottom is definitely somewhere close. Because every now and then I've been reminding for several good weeks that when we lost support on chain at the level of $92,000, around this level here, it was indeed. Then, with a very high probability, there was a drop to around $72,000. And it was a scenario that we were playing out and considering very much in our thoughts. And this is not a random price level. That's exactly where the average purchase cost of Bitcoin by short-term investors, also known as short-term holders, is located. And here, indeed, those $92,000 to $3,000. That was a level which, once lost, caused even stronger declines, according to one of the metrics. And the average purchase cost of these short-term holders, let's call them that, historically, served as a very important support level during upward trends. And last Monday, we were already very close to that level. If we were to continue seeing declines in the coming weeks, it's worth keeping an eye on $72,000 per Bitcoin. Why? Well, because it could potentially be a great moment to buy discounted Bitcoin and altcoins. And regarding discounted altcoins, well, there are those. Currently, there are a whole lot on the market in the face of this prolonged multi-month correction. For instance, the largest altcoin in the world, which most of us have in our portfolio, namely Ethereum, is currently hugely undervalued, which I've been talking about for weeks. I gave the example of VRVZ, since it's in the green box. Here you have this little rectangle, which historically, as you can see, has almost always marked great moments for accumulation. So as soon as the market condition improves, Ethereum should move out of this green zone and not return to it for a long time. Of course, this is wishful thinking, but based on historical assumptions from these repetitive, cyclical events that occur in the market, it should simply be this way and it should happen. That's what I'm indeed looking at. So, in my opinion, we are indeed near a local bottom. Will there be another deepening? It's possible. We allow for that thought. We would prefer it not to happen again, because a lot of bad things have really happened in the market. However, I assume that there is a greater chance that we will slowly, but surely, move upward, and we will start to pick up with this bull market somewhere in the coming weeks. There is a chance for that over the next week, considering the indicators that point to cyclicality or deepening of correction troughs, this correction might occur. If within the next 7 to 10 days at most, there is no such deepening, I will be even more, let's say, the predispositions I give to the market for this and hope that indeed this correction has ended and that we will start rebuilding from these values. Of course, we could drop to 80,000, but I hope that then we won't fall to 70, for example, for again, right? And likewise, that Ether won't fall into the range $1,300 to $1,400, because that would be quite a drastic change, even from the current values, as it would be another 20% correction, which many people might already be tired of the market. They simply might not withstand it. So, in short, it's worth being prepared for the market to soon start discounting this rebound. Moving on, it certainly looks like the whales are constantly preparing here for the continuation of Bitcoin's growth. Recently, I've often shown you the indicator of the number of entities holding at least 1,000 units. Brawl. And in this cycle, there are still no signs of distribution from the whales. Additionally, we have just hit a new cyclical peak, specifically in terms of the number of entities holding at least 1,000 Bitcoins. Previously, this peak was in mid-December, and the number of whales was 1,730 at that time. You know, 1,000 Bitcoins is quite an achievement. Currently, that's $85 million, which is no small amount of money. Today, there are such people, such entities, such wallets. Yes, because often these wallets belong to one person. There could be, for example, such wallets here. For instance, 1,732 at the moment, which is two more. We've surpassed that mid-December peak, but it might belong to, for example, 1,000 people, right? So let's say, plus or minus 1,000 people on these external wallets, not counting exchange wallets, actually have over 1,000 Bitcoins, which is over $85 million in this cryptocurrency. It's also worth knowing that, let's say, billionaires, officially, there are around that number in the world as well. Now, this number might have decreased a bit due to price drops. Let's say there are 700 or 800, so about 50% more people roughly have $85 million in Bitcoin than there are billionaires in the world, or these wallets also belong, listen, to entities, to institutions, often. So it's not just individuals, but also companies. So we can't reduce this to private individuals. But the truth is that bigger players are positioning themselves for these increases and are already accumulating Bitcoin, which, regardless of the current stage of the cycle, is at quite a nice discount. And so, from my perspective, the question is, what else strengthens the argument that the situation in the risky asset market, and thus cryptocurrencies, will simply improve? Let me explain to you. Well, my dear friends, something we've been discussing for a few weeks. Inflation is slowing down. Last week, the CPI and PPI inflation results were published. The former fell to 2.4% year over year, which was a lower result than expected. The PPI inflation is also nicely slowing down to minus 0.4% month over month. So the falling inflation and the current market situation indeed provide the Fed with strong arguments to consider a 100% rate cut, and that's a fact. The Fed's preferred measure is the PCE inflation, the results of which we will know in 2 weeks, but the slowing prices simply give a lot of hope that this reading will also be positive for cryptocurrencies. Here in this table, which you have in front of you, it is compiled a lot of predictions. The largest banks in the USA predict that the latest reading will indeed show a decrease in PCE inflation to 2.6%. If this inflation starts to slow down, then the Fed might decide that, listen, hey, the initial 100% cuts, which were aimed at controlling rising prices, have already fulfilled their purpose, and a 100% reduction could therefore simply support further economic growth, especially in the context of growing uncertainty, economically related precisely to the tariff war. And so far, if we take a look at the upcoming FOMC meeting on May 7th, most of the market is still betting on a pause, meaning there will be neither cuts nor increases in interest rates. This means that the start of QE, or quantitative easing, which is so needed by the cryptocurrency market at the moment, well, fortunately or unfortunately, we'll have to wait a little longer. However, this table also adds some optimism. Take a look. Here are the market predictions regarding the future monetary policy of the Fed. If we were to be guided by it, by the end of 2025, we would witness at least 1 or 2 rate cuts, maybe even 3. The first is scheduled for June, with subsequent ones to be set at future FOMC meetings, and the target interest rates are expected to be at the level of 350 to 375 basis points by the end of this year. And the question is, what does this mean for cryptocurrencies? What conclusion can be drawn from this? This means that despite the enormous fear and uncertainty associated with the trade war, potentially good times are coming. Good times for cryptocurrencies. Liquidity will gradually increase. For months, we've been saying that this needs to happen for the cyclicality to be maintained and so that at least what has been somewhat broken can be repaired. The second half of this year seems favorable for risky markets, as this monetary easing will increase liquidity, add capital to the stock exchanges, and thus cryptocurrencies should benefit from it. And, precisely for us, the investors, in these uncertain times, well, I wish you a lot of patience. Yes, nerves of steel, sticking to your own strategy, because the current local increases may signal to us that the markets are already starting to react, slowly, moving towards discounting the change in monetary policy and its easing, yes. And another argument at the bottom might already be behind us is what you can see on this chart. It's a signal that simply shouldn't be ignored. I'll show it to you now. Here you have shown, listen, the main American indices, for example, the Nasdaq, which have experienced a 20% decline. Recently, many people are saying that it will get even worse. We're going down further, right? But history and hard data tell a completely different story. This chart of the 50-day returns of the Nasdaq index shows that the current declines have reached a level that historically occurs very rarely, and such strong pullbacks occurred, among others, in March 2020. You know what started then, or at the end of 2018, and each time, they preceded dynamic, often double-digit rebounds in the following 50 sessions. If history is to repeat itself, there might at least be a strong rebound in the large tech company sector, which would cause cryptocurrencies to rise as well. And a rebound in the traditional market will also help cryptocurrencies, because Bitcoin is becoming more mature, let's call it that, like an old wine aging in the cellar. As a result, it is increasingly correlated with the main stock indices, which is simply shown to us by Pearson's correlation. If the Nasdaq were to rebound, then Bitcoin would also start its rally within the next 50 trading days on Wall Street. So, this would align beautifully with the fact that, according to cyclicality, for example, by the third quarter, Bitcoin could and should reach 100 and several tens of thousands of dollars and even surpass the all-time high set in January by 20 to 30%. So, now we move on to the next, in my opinion, very important macroeconomic issues. I also remind you that I appreciate your contribution to the growth of the channel, so a thumbs up and subscription will be appreciated if you value my videos and my work, which I put in here together with the people who help with editing, preparation, content, and research, so I would be very grateful. I don't personally claim yet that it's the end of the 4-year cycles, that everything is broken and won't work, but we can't focus solely on that. It's one of the metrics, not something that solely leads the way. Because this happened in previous crypto hosts, the market is relatively fresh. It doesn't always have to happen one-to-one. As we saw in the first quarter, it's a lesson for me too, so we have new rules in the market. Liquidity is the most important. At the moment, I discussed the topic of cyclicality in detail in a video a week ago, so if you haven't seen it yet, I encourage you to catch up. I also pinned it in the top right corner, and you can find it on my channel. But returning to today's update, take a look at what has been proposed. It's about a fresh initiative from the U.S. Department of the Treasury, which is considering buying back older issues of Treasury bonds from the market. In other words, simply put, the U.S. government wants to buy back from investors some of the previously issued debt, which is currently not very liquid, in order to improve, in short, liquidity in the bond market. And such a move is simply a novelty in the current macroeconomic context and a great example of how the rules of the game are changing in the markets. And why is this so important? Well, because it's not typical quantitative easing, as it doesn't directly involve the Fed. However, as the analyst notes, the effects can be very similar, especially if the bond purchase is conducted on a large scale. This could happen, for example, by using the funds accumulated in the Treasury Department's account, known as the TGA, Treasury General Account, or precisely through such special issuances of new, short-term bonds that would finance the purchase of older debt. So why would the U.S. Treasury even consider doing something like this? Well, currently the bond market is in a difficult situation. That's the first thing. Older bonds are piling up in the portfolios of banks and funds. They are causing significant liquidity problems, and bond purchases by the Treasury Department could somewhat relieve the market, reduce stress for bond dealers, and simply limit the volatility that has recently increased in both the bond and stock markets. But there's also an analyst, take a look here, I'll show you in a moment, who points out several very important issues. Firstly, the Treasury Department currently has limited funds. The balance of this TGA account as of April 25th is simply low. So, to carry out such a buyback, it would probably have to issue new short-term bonds, meaning converting long-term into short-term, which increases the risk that this debt will need to be refinanced again soon. So this is the so-called rollover risk. Secondly, historically, similar actions were used, for example, in Japan, and they generally yielded limited or mediocre results. Such an operation can temporarily, of course, and it's true, stabilize the market, but it does not fix the fundamental issues with the demand for Treasury bonds. Thirdly, the purchase of bonds can trigger an unintended psychological effect on the market. Investors might then simply start asking, look here, why is the government suddenly buying these bonds? Is liquidity collapsing? Is something wrong happening? Right? Which paradoxically could actually lead to even greater nervousness in the sell-off of long-term debt securities. And according to the analyst, the U.S. Treasury here realizes that the long-term part of the bond market is very sensitive and is trying to act before a serious liquidity crisis fully erupts, right? The problem, however, is that if it doesn't do this carefully, it could have the opposite effect and accelerate the crisis, instead of mitigating it. So, to sum up, the proposal makes sense, of course, but only in the short term and under strictly defined conditions. It's more of a liquidity management tool than a cure for deeper fiscal problems. And if the Treasury Department handles it poorly, for example, it will finance bond purchases through short-term issuances or exhaust its resources from the TGA. It might worsen the situation instead of improving it. That's why I keep emphasizing that today we need to monitor the actions of these institutions that impact market liquidity, because this will determine what happens with the cryptocurrency market in the near future. And with altcoins, which could also potentially be the next growth phase in the cryptocurrency market, it's not said that they won't have their moment in the spotlight. I personally believe in this. I have those longs, and as I mentioned, I assume that potentially Even the spots from the table you see in front of you, which I updated some time ago and is available on my Telegram, will still be in the positive and come back into favor. And it's not without reason that I averaged them instead of putting money solely into Ethereum or Bitcoin. So I assume that things will still go well, and I'm playing this bet that third time's the charm. If not last year, that February, March, which most people played poorly and also had altcoins that needed to be held onto. I did the same thing back then. Not great, to put it mildly. Then, indeed, a super rally from that time, from July, when I switched it to December. An amazing spectacle. Immodestly speaking on my part, I significantly outperformed Bitcoin returns during that period. I rebuilt my portfolio. I also allowed you to play many profitable positions. XRP, some Jupiters, Solanas. A lot of things were bought, which made 200, 300, 400% returns. Dogecoin sold at 47 cents at the very peak. Also, if I find it somewhere in the editing, I'll put it on the screen for you. So these are all moments where indeed, a person starts to wonder earlier if it's all justified, and then it turns out that the crypto market, in 6 months, can give back a lot, actually in 4 months, from August to December. So here I decided that I will continue to play it this way, that the next 6 months can still change a lot, and even if someone's portfolio took a hit, in these last few months, didn't do DCA, went all in, didn't follow various rules and guidelines that we go over on the channel, it's still not all lost. In my opinion, even losses of around 50 to 70% can be recovered in the next 6 months, and I'll help. I'll do everything in my power to make that happen. But okay, moving on, a lot of people are wondering where we are now, what the next move for the USA is. I have another post for you that, in my opinion, accurately describes what the United States is doing now. According to the mantra here, a colleague I often reference from the industry, the financial system, as we know it is currently being destroyed. And certain entities are doing it intentionally. In his opinion, the United States is slowly declining. He wrote that if you wanted to destroy a country without firing a shot, you would do it like this. And the first step is to kill the currency with a smile. That is, with a smile, because it is done in a planned way so that as few people as possible realize it. How are they doing it? Let me explain. Through inflation, diluting the value, and continuously increasing the issuance of the dollar through endless spending and monetary easing. Next is hiding this theft with false inflation indicators and altered CPI costs. And in the meantime, the Fed and the Treasury Department are colluding. One prints more money, the other goes into debt. And what is the effect? Well, every dollar loses value, and society silently loses purchasing power. The second step here is suppressing interest rates to maintain this scheme, because in the current market situation, interest rates should be much higher, but they are not. And why is that? Because raising them would primarily expose the insolvency of public debt. That's why the Fed continues to buy bonds through hidden QE, using repos and temporary mechanisms to artificially suppress yields. And the last third step is the downfall of the middle class, because every artificially lowered interest rate fuels stock market bubbles, inflates the housing bubble, and increases wealth inequality. What does this mean for the middle class? First, rents are skyrocketing. Second, savings are dwindling. Third, wages are not keeping up with inflation. And fourth, credit cards fill the gap as long as they can. And according to him, Trump's role in all of this is as controlled opposition, because he talks like a populist, right? In reality, he serves the interests of central banks, and during his first term, he supported low interest rates, called Powell crazy when he didn't want to lower them further, and oversaw a record increase in debt. And what is he doing now during his second term? Right? He returns, once again calling for lower interest rates, which will result in a decrease in the purchasing power of the dollar. So, take a look at these two news items from the past week, for example. First, the Fed assured us that they are always on standby in case of a worsening market situation. If necessary, they can stabilize the situation and turn on the printers. And secondly, here we have another example that the American Central Bank will most likely have to intervene soon due to what's happening in the bond market, because Jamie Dimon suggests that the Treasury debt market might freeze or become blocked, which will be the result of tightened banking regulations, simply limiting the ability of banks to operate in the bond market. According to Dimon, as soon as the situation becomes serious, the Fed will have no choice and will have to act. And Dimon is lobbying here for regulatory changes, especially for the restoration of exceptions in the SLR rule, or supplementary leverage ratio. And this exception was previously applied temporarily in 2020 during the COVID crisis. It allowed banks to increase their activity in the bond market without additional capital burdens. And Arthur Hayes also emphasizes that if Dimon gets what he wants, which is the exemption of banks from this SLR rule, it would mean increased liquidity in the market, which would be extremely positive for Bitcoin. And interestingly, last night we received information that China, they plan 100% cuts and a reduction in reserve requirements, which indicates serious liquidity problems that require urgent intervention. So, in short, we're talking about another giant planning to decrease the purchasing power of its currency, which in the long term should positively impact risky assets. I also wrote about this last week on my Telegram, because I hope you understand what this system is about and why I'm betting on the reduction, 100%. Because it's not something I personally desire. I'm just positioning myself for it currently. That central banks will constantly want to print. Some local fluctuations don't bother me. I've gotten used to them. I've developed a tough skin, cold blood like a witcher after these years in the market. It doesn't affect me much anymore. It doesn't change anything. I feel a bit sad for a moment when it drops everything. 30% or 40%, but it happens. Life goes on, I average out, add capital from other investments, from business. Over time, wounds heal and it's okay. So that's how it always is. I simply have the vast majority of my capital in spot, only a little is in longs on my leverage. No liquidations. Threaten the entire portfolio, you know. In leverage, I have about 12% to 13% along with orders. Now, since Bitcoin has made some profit, I play long term, right? This allows me to sleep peacefully. As you can probably see, the situation in the debt market is tense. And before central banks step in more forcefully, something will have to break. That's why I still don't rule out a final, strong correction. I simply have orders prepared at lower spots on the spot market and in leverage, but with altcoins, I'm just patiently waiting for the situation to develop. In the long term, I remain bullish, nothing changes, I'm not packing up and disappearing from this market. But I just know that for many people it was unthinkable, because there were supposed to be increases, but that's usually how it is. When most people assume there will be increases, when most people enter the market, something happens that they don't make a profit. Aside from the purely market aspect, they will also compulsively and emotionally make a lot of foolish decisions. So, regarding altcoins, here are a few news items. First, we have a new Luna in this cycle. You know, the mantra blockchain of the first layer. Here, layer 1 is focused on the RWA sector. A shocking drop of over 90% in just a few hours on a Sunday afternoon. Without any explanation and without an immediate announcement, everything plummeted, making this altcoin a sensational leader in the RWA sector. In this cycle, it reached a market capitalization of around $8 billion. Meanwhile, its market cap has currently shrunk to $600 million, and it is still unclear what triggered the cascade of declines. It all started when a wallet associated with the Mantra team sent several million tokens to the exchange. This caused concern in the market. As you know, trackers found it. The team here controls about 90% of the token supply, so they were afraid that there would soon be sharp dumps. As they say, right in the face. Additionally, there were rumors that the Mantra team arranged an OTC delay with some private investors, where they were selling them this token with the ticker OM at even 50% cheaper, and that was like adding fuel to the fire. The effect was simply a chain reaction, a massive drop, which shows the power of fear and panic in the market, because everyone wanted to sell it as quickly as possible to avoid being left with nothing. After this event, I doubt anyone will take this project seriously in the long term. I doubt it will gain traction. It would be phenomenal if the token returned to its previous values, so there will definitely be opportunities to profit from swings. In the near future, volatility will be from these low values. But if you're looking for gems in the RWA niche, you already know what not to invest in for the long term, because after such a history, it might be rather difficult. What else do we have here? An ETF. On Solana, the first one, is just starting here, April 16th. So in just a few hours, the ETF, here, not in the United States, but in Canada. This instrument will be traded, and from now on, institutional and retail investors will be able to have exposure to Solana in a regulated and safe manner, without having direct exposure to the cryptocurrency, and making it easier to handle tax-wise for those who are not familiar with the topic. So Canada has also sent a clear message, a signal to the USA now and to the rest of the world, that altcoin ETFs are not just a dream. It's not just Bitcoin and Ethereum anymore, but a reality. It's coming faster and faster. Wrapping up the topic of ETFs, I have another interesting piece of news for you. Namely, the 21.shares fund has joined the group of companies that have filed applications to create a Dogecoin ETF. In the past, similar documents were also filed by Grayscale and Bitwise. The importance of euro-backed stablecoins is also growing as the capitalization of EuroC. Circle stablecoin has doubled since the beginning of this year and has become larger. Circle is also the issuer of USDT. Of course, especially after the law came into effect. Mika highlights the growing role of both Circle as a regulated issuer and this digital euro. Subscribe to the channel. Thumbs up. Take care for now. Bye.